Some investors follow the rules, while others rewrite them. Some seek steady gains, but a rare few shape entire economies with a single trade. George Soros belongs to the latter group. A hedge fund legend, a master of macro investing, and one of the most controversial figures in financial history, Soros has influenced not just markets, but governments, currencies, and even global politics. This is the story of George Soros, the man who broke the Bank of England, the architect of global financial strategies, and a philanthropist who has shaped both financial markets and political landscapes worldwide. Stay with us as we uncover his journey from a war refugee to one of the most powerful investors of all time. George Soros was born György Schwartz on August 12, 1930, in Budapest, Hungary. His early years were shaped by war, survival, and resilience. During World War II, Hungary fell under Nazi occupation, and his Jewish family faced constant danger. To survive, they changed their surname to Soros to avoid persecution. His father, Tivadar, was a lawyer, but also a strategic thinker who helped Jewish families escape using forged identity papers. These early lessons in deception, adaptation, and survival would later influence Soros' investment style, where analyzing risk, anticipating crises, and positioning ahead of market collapses became second nature. After the war, in 1947, Soros fled Hungary, escaping the rise of communism, and moved to London with almost nothing. To afford school, he worked as a railway porter, a nightclub waiter, and even as a manual laborer. Despite financial hardships, his academic brilliance earned him a place at the London School of Economics, LSE. Here, he was deeply influenced by Karl Popper, a philosopher who developed the idea of the open society, a belief that free markets and free thinking are essential for societal progress. Popper's philosophy became a foundation for Soros, influencing both his financial decisions and later his philanthropic work. Despite his brilliance, Soros struggled to find work after graduation. His first job was at Singer and Friedlander, a merchant bank in London. However, he saw little growth potential in Europe and aimed for a bigger stage, Wall Street. In 1956, he moved to New York and landed a job at F.M. Mayer, where he specialized in European securities. At the time, most U.S. investors ignored European markets, giving Soros a huge advantage. He leveraged his expertise in international investments and quickly gained recognition. By the 1960s, Soros had developed a unique investment approach, combining macroeconomic trends, political risk analysis, global currency movements. Unlike traditional investors who focused on individual stocks, Soros wanted to understand how entire economies moved. This global macro perspective became the foundation of his hedge fund strategy. In 1969, Soros launched Soros Fund Management, which evolved into the legendary Quantum Fund. Unlike traditional hedge funds, Soros focused on global macroeconomic trends, betting on currencies, interest rates, bonds, and even government policies. Quantum Fund became one of the most profitable hedge funds of all time. Between 1969 and 1979, the fund delivered an astonishing 4,200% return, compared to just 50% for the S&P 500. This unprecedented success solidified Soros as one of the most powerful investors in history. The trade that shook the world, Black Wednesday. Black Wednesday refers to September 16, 1992, when the British government was forced to withdraw the pound sterling from the European Exchange Rate Mechanism, ERM, due to heavy speculative attacks. The ERM, introduced in 1979, was designed to stabilize European currencies in preparation for a single currency, the euro. The UK joined the ERM in 1990 under Prime Minister John Major, pegging the pound to the German mark with a permitted fluctuation band. Germany's high interest rates, driven by the costs of reunification, put pressure on other ERM currencies. The pound was particularly vulnerable due to high inflation and economic weakness in the UK. On September 16, 1992, speculators, led by George Soros, heavily shorted the pound, betting on its devaluation. The UK government attempted to defend the currency by raising interest rates from 10% to 15% and using reserves to buy pounds, but the efforts failed. By the evening, Britain exited the ERM and the pound depreciated sharply. The UK Treasury estimated losses of £3.4 billion from Black Wednesday. However, in the long term, the crisis led to a shift toward direct inflation targeting, which contributed to economic recovery, falling inflation, and stronger monetary policy. The event also reinforced skepticism about the UK joining the euro. Key lessons: market forces can overpower government interventions in currency markets. Pegging currencies without strong economic alignment can lead to instability. Black Wednesday ultimately paved the way for more effective UK monetary policies. Soros's investing strategy is based on market psychology, global trends, and economic shifts. His core investment principles include reflexivity. Market prices are influenced by perceptions, emotions, and speculation. Macroeconomic betting. Investing in currencies, governments, and entire economies is often more profitable than stock picking. High conviction and risk management. Soros takes big bets but carefully manages downside risk. This strategy helped him profit from crises, bubbles, and major economic shifts. Beyond Black Wednesday, Soros made several other legendary trades. 1987 stock market crash. He positioned Quantum Fund correctly before the crash, making massive gains. 1997 Asian financial crisis. He shorted the Thai baht and other Asian currencies, making hundreds of millions. 2008 global financial crisis. While most investors suffered losses, Soros's fund profited from economic turmoil. His ability to anticipate financial collapses and profit from instability made him one of the greatest hedge fund managers in history. Soros didn't just invest in markets, he invested in ideas. In 1984, he founded the Open Society Foundations, supporting democracy, education, and human rights. Over the years, he has donated over $32 billion, making him one of the largest philanthropists in history. However, his influence has also made him controversial, with critics accusing him of using his wealth for political influence. Regardless of opinion, his impact on finance, philanthropy, and global markets is undeniable. So what can we learn from George Soros? Think beyond stocks. The biggest profits come from betting on currencies and global economies. Risk-taking is necessary. Big bets can lead to big wins, but risk management is key. Market psychology drives prices. Investors' perceptions shape market movements as much as fundamentals. His legacy as a financial visionary and philanthropist continues to shape global markets. If you enjoyed this deep dive, hit like and subscribe for more legendary investor stories.